fundsupermart.com.
Hi. The S&P 500 index gained 30% before accounting for dividends in 2013. Did Aberdeen expect this strong performance at the start of 2013, and what were the reasons for this?
I think we certainly expected a good performance from the S&P. We didn't quite expect the 30% or so. That's always tough to take because some of that was driven by technical factors. You think that corporate fundamentals were good, but certainly not worth 30%. Operating profit growth was high single digit, and yet you got a 30% move. So, like many others, we were surprised by that.
What is the Aberdeen's team expectation of the US equity market in 2014?
I think for 2014, we certainly expect equity returns to be positive this year, just more modest. We tend to think of operating profit in the 5% range. That would be 3% like GDP and a little bit extra for margin expansion. We then can add in dividends, call it 2%. Share buybacks can probably do a percent. And then you've got probably some room, but not much, for valuation expansion. The market on a forward earnings basis at 15, if you put it on a 16 multiple by the end of the year, you can get reasonably comfortably high single, low double-digit type of returns, which we think is very healthy for a market that's increased 2.5 times since the low of 2009, albeit earnings have doubled. So still something to shoot for, but let's not get carried away that 13 was the norm, it was the exception.
Any discussion on US markets is incomplete without a discussion on QE tapering. What's next now that QE tapering has been officially announced?
I mean, for us, tapering is one of those exogenous or external factors that we don't naturally want to think about because we're much more focused on bottom-up fundamentals of companies. That said, our companies do exist in the real world, and Fed monetary policy is a factor on their valuations and their earnings backdrop. QE, we do expect the Fed has announced $5 billion out of its treasury purchases, $5 billion a month out of its corporate bond purchases. We would expect that to continue to get tapered, and there's not an inconsiderable probability that they do stop that they do remove all purchases by early second half of this year.
Lastly, what is the best way investors can gain exposure to US equities in 2014?
I mean, it won't be any surprise for me to say that we believe the best way to invest is in quality companies through the long term. Regardless of market cycle, we do tend to assume that the best approach is one of a buy and hold investor focused on good, strong companies that can perform throughout an economic cycle and get stronger through that economic cycle. We won't change our disciplines and our strategy, but over the long term we expect to get paid for that type of approach. It wasn't really rewarded last year when quality did not pay. Over the long term, though, we expect quality to pay.